Levi asked, what's your take on peer-to-peer lending? He says, I'm returning 11% on the platform of Lending Club, but I'm down around 40% on the stock. Would you talk about peer-to-peer lending and what hurdles/regulations are needed to clear before these companies can do well? Do you want to give just a basic description of what peer-to-peer lending, which we're probably just going to call P2P?
Yeah, so peer-to-peer lending or P2P lending is basically where you have a company that sets up a platform, and then if you want to get a loan for, I don't know, like in the example we were talking about earlier, like you want to like start a company that like makes coffee cups with like pictures of cats on it, and then like the cats are like maybe like doing things like riding bikes or things like that, and then like that's your thing, that's your business idea. And you go to a bank and you're like explaining this to the loan officer, and you're like, look, it's going to be a great idea. It's going to be coffee cups, and then there's going to be pictures of cats riding bikes, and they'll be saying things to other cats who are maybe like riding on hoverboards. And then the bank is like, well, I don't know, that doesn't seem like a very viable business model to me. So then you'd be like, well, I still need capital, so where am I going to go get it? So then you could go to one of these marketplaces, and you could put your idea on the marketplace, and then people on the other side of that, like you and me, we have maybe a few extra $1,000 that we're looking to invest, and we want to diversify away from stocks or real estate or whatever your thing is. And then these people say, look, I'll give you a 8% return on your money. I'll borrow your money and give you an 8% return on that, so then you can fund my business to make these awesome cat mugs. And so that's what peer-to-peer lending is. It's me, a guy with a little extra money, going onto this platform and loaning it to, say, Joe Schmo, who wants to start this business with, making cat mugs, which I'm sure is going to be awesome and profitable, but yeah, the banks don't realize that potential.
Right, and people use this for all sorts of things besides starting small businesses. They use it to fund. The most recent one I saw was student loans, mortgages, stuff like that. Just loans for money for home renovations. And when you go into the loan, when you click on it, it'll give you a description of the person and the thing that they're using the loan for. So it'll be like, it's a nurse and she's between 30 and 35 and she makes, I don't know how much nurses make, like $70K a year. So and I want to let me be clear. I'm not trying to belittle what peer-to-peer lending is, but from you're talking about a very niche market where people probably aren't going to be able to get mainstream credit. And when you think about why aren't these people going to be able to get mainstream credit, then you start thinking about credit risk, because banks want to give credit, right? What banks do is they sell money via loans, but they're not going to sell money to people that their risk models say are not good credit risks, or at least like, right.
Well, they have done that in the past, right? That's what the financial crisis was all about. But like theoretically speaking, banks don't want to do that.
Right. Well, and then the financial crisis beat them up. So they're very interested in not doing that again. And the thing with banks is they have these super sophisticated models that give them a pretty good idea of whether or not a person is a good risk or not, which when you compare to some of these peer-to-peer lending sites. So, for example, Jordan Wathen wrote an article the other day that that showed in it that Prosper Loans Marketplace, which is one of these peer-to-peer lending sites, it's not public yet, but they submitted an S1, which is kind of like part of the paperwork that you need to submit to get yourself listed. It says that Prosper verified employment and or income for 59% of the loans originated on their site. Banks verify that for 100% of people that they give loans to, not 59. Like that's a huge difference. And then from those loans where they verified the income and or, employment, they delisted 15% of those, that's quite a few. You know what I mean?
Yeah. And then you think like, so let me get this straight. So they checked the income and the credit characteristics of 59%, and then 15% of those 59%, is that, were the ones that they then took out? So then what happened to the other 41%? They
didn't get checked at all. They just left them up on their site. Like so who knows how many more would have been delisted.
Yeah, that's great. Yeah, that's great. That's great. And this is really, really, really risky, right? Yeah. That's kind of what the point that you're trying to make. And
it's super risky. And you know what? And Prosper is not alone. Like Lending Club, it doesn't disclose how many of its loans it checks. It just says it doesn't check all of them. So who knows what that percentage is?
Like Russian roulette.
Yeah, pretty much.
But here's the other interesting thing to talk about kind of another specific company. Then you look at like a lending club, right? Lending club, if you go to their board of directors and you see who's sitting on that board, you have Larry Summers, right? A former Treasury Secretary who, and Gabby and we've talked about this in the past, like, Larry Summers, he can be controversial in terms of some of the things that he says, but there aren't a lot of people out there in the financial world who really know what's going on, who would question his intelligence and what he knows about finance and the economy and stuff like that. You also have John Mack, who is a former CEO of Morgan Stanley. You also have Mary Meeker, who's a partner at Kleiner Perkins. So these are not like, Lending Club in particular is not some like fly-by-night company. I mean, these are established people who know what they're doing, but they're evolving towards a different business model than the I'm lending to John Maxfield is lending to Joe Schmo. They're evolving to where they will originate small business loans and then syndicate those to like a whole bunch of community banks who don't otherwise have exposure out of their local markets.
Yeah, and I could actually totally see that working. But I think part of the reason that people are down on the actual stocks themselves versus like maybe whatever loans they've made within the platform is because there is so much uncertainty there. And it seemed like a great idea when it first came out, and then people started reading more and more about it, and stuff, like I said, that came up with them actually checking who's listing these loans is not certain. Even if that's not even certain, like it's kind of sketchy. So until these things get worked out, I don't know that it's a great idea to invest in these in particular. Also, this is an area that's ripe for regulation that hasn't been done yet. And until that happens, it's very hit or miss whether or not this will survive in general. You know what I mean?
Yeah, that's a really good point. That regulatory point is actually a really good point I haven't thought about. Just, as somebody who, my real specialty is the history of banking, and the history of banking is made up of credit cycles. And if you go back to basically the start of the United States, we've had something like 20 of these huge, large credit cycles. And what I mean by that is, where loan losses are really low when the economy is going great, and then loan losses go really high when things turn bad, which is what we saw in the Great Depression, the financial crisis, stuff like that. So the big question to me, and I'll provide an answer after I state the question, the big question to me is whether or not these companies or this model will survive a serious downturn in the credit market. And it's my opinion that there's no way they're going to make it through one of those. I could be totally wrong on that, but the quality of the borrowers that are on these platforms, as I understand it, are the bottom of the barrel. And when in the bottom of the barrel, in terms of like your credit statistics, those you just see huge loan losses on those when the cycle turns down.
I mean, I guess the other side of that would be, where else would these people get money from? And the answer would be like payday lenders, and that's probably way worse than this for them.
Yeah, for
especially.
them it's way worse.
But for the people investing in it, it's way worse for us.
Exactly.
Yeah.
Exactly.
But anyway,
and then you can also say like maybe they shouldn't be going out. If a bank looks at their business plan or whatever they want money and is not willing to lend it, maybe they shouldn't. Maybe they should look for other things to do.
Yeah.
Because if a bank thinks they're going to default, and they do default, it doesn't matter what the platform is, that's going to ruin your credit, right? So maybe that should be a sign to people who are looking for loans over these platforms.
Yeah, it's a hard question because it's like, if people need the money, where do they get it from? But like, if there's such a bad risk. Anyway, this is a question that is not for you and I to solve, Maxfield.
This is philosophy.